Hey everybody, this is David Skarica. So we're gonna do this is the last of our kind of like the 3-for-1 specials that's free. So like I said, what I'm gonna do is I'll do basically Tuesday, Wednesday, Thursday. I'm gonna do the stock chart of the day. Maybe Monday too, if I have nothing else going on that Monday. And then on the weekends for just the regular free people, I'll do another one. And then the 3-for-1 will be for the paying Patreon members, right? So essentially you'll get 8 to 9 charts a week, or whatever, 3-for-1, 4-for-1, whatever it is. It's going to be more like a market overview. So I don't even want to really say it's like 3 charts because you're going to see, I'm going to talk about a lot of things today. And then, so this is kind of going to be a mixture of that one, that's the free one, and the market overview, because this is the last one that will be for free. I'll probably leave this up on the site. I was going to actually do, I guess I'll have to do that another day. I was going to do 4 charts in 2 oceans because we're on the island. I can go the Atlantic and then I can go over to the Caribbean, but I got a flat on my car, and then that kind of set that back, and I fixed it and just decided to come home and just do the regular one here. So this will come out Sunday. I think today's the 24th, Sunday, September 24th. Yeah. So anyhow, and I'm going to show you a little side venture I'm doing. It's really, if you're a football fan, obviously the support for that would be great. All I'm looking for is views and follow. And I don't even care. Like, I'm doing this thing for fun. It's like, if like 5 people watch it, I'd be happy, So we're going to quickly just go into this. So market sold off. It kind of tried to bounce after the sell-off on, I don't know why the market was even like going back and forth, because it was obviously from the Fed meeting. We'll go look at this for a second too. With the Fed meeting, the TLT bounced a tiny bit. You can see we're basically at new lows here for this move. They essentially are saying they're going to keep rates higher for longer, which I've been predicting. It's funny that for the last year and a half now, everyone has continued to predict a pivot or a dovish move, and I kept saying, not that I'm a genius or anything, that's not going to happen. And now we're seeing rates back to where they, were near the highs of last year. And one thing we must remember that last year, when rates actually were getting a little above them, but anyhow, roughly the same, just a tiny bit above. Remember, the S&P was like 3,600. Now it's like 4,400. And actually, I saw a stat. I think I'll find it on my Twitter as well, that the S&P, it's like 7 stocks are like 52% of the move. So it's like, or sorry, 7 stocks are on average up 52% year to date, like all those big tech stocks that we talk about, right? So what we're going to look at here is, well, so we look at the market, we'll look at housing in a second. So the S&P kind of reversing, it's right at the support level here. This is the spiders, but we'll look at the S&P as well. You can see it's right at this 430. And I think if it breaks, we go back to the 200-day moving average. And the question is, do we kind of hold it like we did in March, or do we roll over? I think we're going to roll over. Now, the question doesn't mean like we have to have one of these October crashes, right? Like I've talked about the year 2000 a lot. We'll go look at that in a second. Let's go to the S&P. Yeah, and we'll go look at the NASDAQ. So this is what I'm saying. We're doing a whole bunch of starts. I always get that wrong because it used to be CompX and now it's CompQ on here. Yeah, and you can see the NASDAQ is right at support and rolling over. So anyhow, that's basically it. And you can see this is like 10,200 again, like where we were last year when rates were the highs. The NASDAQ was essentially 3,000 points lower, which is like 25% from current levels, right? And we look at these stocks that I talked about, like look at Microsoft. These stocks are starting to roll over now. Microsoft began the year at like 230 and went to 350. And then we look at Apple, same thing, began the year at 125. And a lot of these stocks began the year at their lows. I think there was tax loss selling going on late last year, and it went to 195, right? Of course, NVDS is the big one, which we've talked about, has basically, tripled this year, and again, it's getting right back down to its support level here. And then, of course, we have Tesla. We'll do that one too. It's the last one we'll look at. So Yeah, and you can see Tesla again has doubled from those lows. Tesla looks like it might be having a topping pattern. But again, the question is Tesla in a consolidation like this or actually topping? I think the issue with Tesla longer term is going to be competition. China's making a lot of EVs. All the major car companies are getting EVs, and there's really not demand for EVs. I think I saw a poll recently that 2% of consumers, I talked about my EV video, want to buy EVs. So it's like, because they're expensive, you have the issues with the battery, et cetera, et cetera. Yeah, so sorry, I just decided to warm up my coffee there. um so this is Tesla right here. So we can see that again what all these stocks have done. So actually this is something I was going to show at home. I'll come back to this because I know I did this on my Twitter. Yeah, here it is right here. So you can see that S&P 7, so that's the largest 7 companies in the S&P, is up 52% year to date. And then thanks for the Kobayashi letter for showing this. And the average stock in the S&P or the S&P or other 493 companies is up like 5%. So again, it just shows you that this has really been led. See, and then what happened, the reason in June, I got a little more bullish, or at least thought, okay, the market's not going to tank in the summer in the short term, was because stuff like we've talked about this in the past, the airlines, the travel industry stocks like the casinos, the cruise ships, all of these kind of sectors rallied. Stocks like Expedia, Airbnb, that kind of thing too. So travel related things, etc. But they all kind of came back right back down, and that tells me that post-COVID boom in travel, where all the restrictions are gone, and this is really the first summer there was no restrictions anywhere, is kind of over, and people are obviously, the stats are showing with credit card debt, etc., people are tapped out. So this just shows us, and again, that's really dangerous because that's once these stocks kind of roll over. And remember, there's another lot of reasons those stocks are out, like stocks like Amazon and Microsoft are benefiting from the cloud services, but even like Amazon looks like, again, if it goes through 125 here, Amazon can really be topping out. So it's like they've benefited from cloud services, and there's the whole AI boom. So that's kind of like driven those companies because they're all integrating aspects of that into their business model. So that's basically it, right? So this is QQQ, and again, you can see this kind of potential topping formation. So what we'll do now is we're going to look back at 2000. So we're going to look back at, I'm going to go back to 1999, and we'll see the bubble, and then we'll go back to the fourth quarter of 2000. And this is the QQQ. And this is kind of what I think we could be like, go look at here. And then it was October, they're kind of broke down to the lows, and it was November, December. Now, note this wasn't like, this is a crash, a slow motion crash, because the QQQ or the NASDAQ 100 went from like, the QQQs went from 90 to like, it went down 50% basically from September to December. That's a 3-month move, right? That's a pretty big move lower. And we'll get the NASDAQ 100 to show you this. Which went from almost 4,200 down to 2,200. So again, almost 50% lower. And then if we look at the S&P, it's the same way. So I think we're kind of in this kind of move now. We're getting close to like the support and the 200-day moving average. We could have a smash in October. Maybe the employment numbers will really show that we're getting into a recession. Maybe oil's been ticking up, as we've talked about. Maybe the oil ticking up will cause a little tick back up here in inflation, and that tick back up will lead to like, oh my god, the Fed is going to stay higher for longer, and that causes a little smash. So we'll know by the end of October, because crashes don't happen in November, December for whatever reason. So basically, if we're like in a 1937 or 29, I don't think we're in that, or like 73, 74, if we're in those kind of scenarios, 06, 07, like we'll show you those in a second. Let's look at the 1937 bear. Well, I've shown that. Let's go to 1907 bear market, and this Wikipedia page has the stock. So you can see here it was the same kind of thing, and then basically everything kind of fell apart in kind of the fall of, the Dow went from 80 to under 60. That's, 20 or basically a 30% down move in just a few months, right, in the fourth quarter. So that's what's going to happen here from now to November if we're in that kind of move. But if we're in like the 2000 kind of move, something like this will happen. And probably with those big tech stocks leading the way, those big tech stocks will lead the way to the downside. So that's kind of what we're looking at here. Of course, the market could also bottom and move higher. Who knows? But like if we go look at the CME group, we're going to look at the Fed funds futures. There's virtually no chance of a rate hike at the next meeting. You can see there's a little bit of a chance, a quarter chance. The best chances are December, which is about 50-50, because, that would be like 2 rate hikes. That's 6% chance. So we're basically at 45%. And it's 46% by January. But then it starts to move lower. You can see we're only at, 40% here, and there's a little chance of a rate cut from current levels. We can see by going out like a year. Remember, right now we're 525 to 550. So you can see only 6% chance that we're here or higher, but by December of next year, and a 96% chance with that we're lower. And that looks like the most likely right now, what they're saying is 450 to 475, and that would be about 100%, 100 basis points lower than here. And it looks like, you go look at here again, there's about a 60% chance we have 1 quarter point rate cut from here, by July, so really it's like it's like 2000 in that they stopped raising rates in 2000. They did nothing really to the end of the year, like 6 months, and then they finally started to cut rates. So I think a scenario like that could play out. Like, let's say that was the last rate hike. We saw, I guess it would have been late July. Well, 6 months would be, like end of this year, early next year, similar to what kind of happened in 2000. See, what happened in 2000 and with that stock market decline is that in January 2001, the industrial production numbers were really bad. Like the industrial production numbers were like showing negative growth. So anyhow, that's basically it, so and then that's why the Fed started to cut rates, because it looked like we're entering like a mild recession. So I just wanted to show you that. So now we're going to go look at let's go look at housings. I've talked about that in the past too. So let's go look at maybe there's something I was going to look at in a second. You can see, so this is your home value to income ratio, and housing. Remember in the 50s, owning a home until about the mid to late 50s was not that big of a thing. Kind of, the kind of leave it to beaver thing is, those days in suburbs that started it, but people's incomes were booming. There wasn't much inflation, obviously, till the late 60s. So you can see home, and like I said, because that was the first housing boom, a lot of supply came on the market. So people, went to actually an all-time low affordability in about the late 60s. Because the problem with that early 60s, one reason the home value to income ratio was low was because interest rates are high. And you can see when incomes began to lag inflation in the 70s, they got more expensive. They got cheaper again into the 90s, because the 90s saw a slowdown in inflation, boom in asset prices, the boom in tech boom in the economy. So people were making more money. So they were still relatively low. And I remember that, like my dad, sold his first house, our first house, the one I kind of grew up in the mid 90s. And I think he bought it for like 80 grand or something. He sold it for like twice that in the mid 90s. He bought it in the early 80s and kind of right at the bottom of the market. And then he bought another house. I guess it would have been in the late 90s. And I still remember it was really affordable. It was like he bought this house, which is probably now worth like $1 million, for like 150 to 200 grand. And then, I remember by the time he sold it, it boomed. And like, sometimes you're better to be lucky than smart. So you can see this is the housing bubble. We went to 4.3x, and now we're even higher because the combination of, again, wages lagging and this huge housing bubble due to cheap money. And again, the housing market, because it's the same, because of dearth of supply, I think because a lot of people don't want to sell because they're kind of stuck in their houses, has not really caught up with interest rates. Like, I'll have another chart that I'll show on my Twitter. So if you want to follow me on Twitter, it's just twitter.com/David Skarica. I'm going to open up my Twitter account this week because it really has to do with the other venture I'm going to talk about that I'm doing. So I really want an open account for that. So just be respectful and all that kind of stuff, right? So anyhow, and like I post, that's what I mean. Like I post all these kind of cool charts and stuff like that. So what I would say is better be lucky and smart is that my father and I both bought our houses right about here. And it wasn't like a genius move with him. He had sold his house and then I'll be blunt with you. Yeah, because unfortunately he was going through his second divorce. And then my grandparents passed away. So he bought out his siblings and bought my grandparents' house. And with me, I decided, I got my ass handed to me, sorry for lack of a better term, in 2008. And all I did was like, I was doing stock deals. I was doing all these junior deals. I had one deal that did fantastic. And then I just rotated the money into other deals and then I got killed. So then I was like, I gotta own something tangible. So I had a junior deal do really well called Tinka. I've talked about in the past. That's how I bought my house. I went from 10 cents to about 50, 60 cents. And then I exercised the warrants. And that gave me the money, and the Canadian dollar was par, so that gave me the money to buy my house. So I bought it right here in like 2011, 2012. And the Bahamas has done the same thing that the US has done. Like my house is more doubled in value, and I don't even look at it as an investment, so I don't really care. And so but again, in terms of affordability, I do pretty okay, right? Like my income fluctuates a lot because when the junior market is kind of dead and stock deals are kind of dead, I don't get a lot of the fees. I don't get as many consulting contracts, et cetera, et cetera. But and I have more of a base income. And I don't have the capital gains from the junior stocks as well. But when that market's hot, I make a lot of money. So what I'm trying to say though is with the increase in price of this house plus the rates, I don't even know if I could afford this house right now, and I do pretty well, so so anyhow, that was just better lucky than smart. My dad, because of his situation with his, marriage, and then his parents happened to pass away, and then he bought out the family house. And then with me having, just decided I wanted to own something tangible. I was in my early 30s at the time as well, about right at the bottom, essentially, so anyhow, but it just shows you the affordability. And let's say even if you're in this uptrend, and the uptrend comes in right at the median. So the median, right, is just over, it's 3.2 times, and it's 4.5 times from here. So we have to drop 30% on house value to income ratio. So you'll probably have a combination of incomes are rising because of inflation and house values will fall. So probably house prices will fall 20, 25%. Incomes will go over 10%. This is over a few years, right? And we'll hit that again, right? But the problem is so many people bought at the high. Now, there wasn't the high in house value to income ratio, but near the highs of the market because interest rates were zero. And remember, a lot of people have 5-year fixed mortgages. So the problem I think and this probably will push down the house prices as well, because I think a lot of people are going to be forced to sell because they can't afford the interest expenditure, is a lot of those 5-year fixed were done in 2020 and 2021. So that's 2025 to 2026 when it's rolling over. So anyhow, so the other one I wanted to look at here, okay, let me go look at here. And there's another one. There's home prices, there's income. That shows it right there. So how sustainable is this? That in the 50s, or like say in the early 80s, the average person was making, or a home was making 60 grand a year, and the average house was, 21 grand. Or sorry, the average person was making 21 grand a year, or this is a right, and the average home was 60 grand, and now it's 350 grand. The average household makes 80 grand. So again, how sustainable is that? And Okay, it was sustainable if rates would have stayed at zero forever because of the lack of interest expenditure, but that's no longer the case, you know? So, there you go. And credit markets are rolling over and that sort of thing. So, yeah, I just wanted to show you that. And here, again, here's another, we're getting onto housing again. So, you can see 19,000 back in the 60s, 495,000 now. That other chart I showed you, I'm pretty sure is, it is inflation adjusted. So, and here's the bank rate, 30-year mortgage, national, highest since 2000. And again, let's go look back at where housing prices were in 2000, right? Housing prices in 2000 were like here, right? They were like 250 grand. Now they're twice that, but the interest expenditure is the same. So that essentially means that the average person, is going to be paying twice the interest on a home as they were in 2000, right? And their incomes aren't up twice, So that's basically it. I think I did enough on the housing right now. So, yeah, I think it's a real disaster. Yeah, actually, here's what I wanted to show you. So, 3 years ago, Charles Biello, by the way, has a great Twitter feed if you ever want to subscribe to him. The 30-year mortgage rate was 2.9%, and median existing home price in the U.S. was $310K. Today, the 30-year mortgage rate is 7.2%, and median home price is $407K, right? So you can see that the result is a $19K increase in down payment, 20% down, and 114% increase in a monthly payment. So people are now paying $1,200 more a month, which is roughly, $14,000 more a year. And for the average person, $14,000 more a year is a lot. And that's what I said, like with my house. Like my house from 2011, I basically paid double for it now. So my down payment would have to be double. And here you got to put 30% down, So, and then here the interest rate is prime plus 3. So I was paying, because prime was 3%, I was paying 6%. Now the prime rate's 8%. I'd be paying 11%. So it's just like totally unaffordable. All the housing boom that's happened here is people that have made money in housing, the stock market in the States and Canada or over the world, then turning around, taking those gains and buying a second home in the Bahamas, or people that are like wealthy, etc. Like I have a guy who lives down the street with me. He used to be the starting right tackle for the Miami Dolphins. So he obviously made a lot of money playing football. And then he was pretty successful in real estate afterwards. So, anyhow, so, that's it on housing right now. So I think I showed you enough. So yeah, like I said, this wasn't really just the 4 charts. This was like kind of a mixture of housing affordability, the S&P, where we are exactly in the market, that a few stocks had just like, carried the market, et cetera, et cetera. So the last thing I'd like to show you is, so the positive outcome for the market, if you want to know, is that if it's like 1994, they're done the rate hike cycle. The market holds into about November. That's what happened in 94. There was a correction in 94. And then it looks like they're going to stop raising rates. And then all of a sudden you see the market just start to take off. And if, and then they cut rates a few times in 95. That would be the positive outcome, right? I guess I can quickly show a chart of that. So this is 1994. We'll go to 1996 just to make it a short-term chart. And you can see, right here, that was the correction that ended in 94. So basically, if we by, I would say by November, December, if the market hasn't broken down, we start doing something like this, that's a sign that probably we're going to be in a short-term rate cut cycle. I don't think we'd have a boom like the 90s. I think it'd be more like the 66 to 68 bull market, something that lasts a couple of years. And that would be the positive outcome. And if we go look at the short-term rates, you'll see that as well. You'll see this here. And you can see the short-term rates in 95 after all these rate hikes in 94. And actually, if we go back to the beginning of 94, you'll really see how many rate hikes there were. It was kind of like the last 2 years. Yeah, rates went from under 3%, you can see, to almost 6%. And there were only a couple of rate hikes, but it was really that the rate hikes were done and, that they were going to cut rates. So you can see in 96, they really stopped in the market. Really, I don't think they raised rates again. I think they did 1/4 point in 1997. But I think other than that, they didn't really raise rates again until 1999. So, so anyhow, that's, and of course, in 94, inflation was a hell of a lot lower, and housing prices, asset prices were a lot lower than they are now. So, yeah. So anyhow, and then to end off on a side note here, I just launched this on the weekend. So this is, my my YouTube page. I'll get the, this is the website. It's just a simple blog website. That's all I'm doing for now. So everyone knows I'm a big football fan, big Raider fan. I have a statistical mind, you know, doing a lot of numbers with, actually, that's one reason it attracted me to the markets, that I used to be a stat nut, you know, in, football. Me and my brother did this thing in the backyard where we had like this football league, and we made up all these players, and we would use our friends' names, and we would go do like, you know, pretend games. This is back before kids had all these computers and tablets and had to use their imaginations, right? And we write down the stats, and yeah, it was pretty cool little thing to do. You know, kind of, you know, made us active and had us go outside, et cetera, et cetera. So we can see here. So this year I talk about, so what I'm doing with this site is every week during the season, I'll do a review of a classic Raider player, and then preview, then like when they're playing a team, I'll preview the team that they're going to play. And I'll get a classic Raider game. Like, so this week they're playing the Steelers. So what I've done this week is, I'm not going to bore you with the details. So just watch the video if you're interested, you know, subscribe to the site. This year I looked at this game that the Steelers, and the year the Raiders won the Super Bowl in '76, they played the Steelers. They had this big comeback win. And I talk about it here. I go over the game. I show a link. You can't go yet. You just have to click it and watch it on YouTube. I show a link to, you know, the game, et cetera, et cetera. So if you're interested in football, I'm going to talk about the whole league too, not just the Raiders. It's going to be focused on the Raiders, but I got some cool articles coming up on some Raider players you probably have never heard of. Because a lot of Raiders fans are really into their history, probably the more NFL fans in the league. And I'm gonna have a series called Behind Enemy Lines. Well, like, I'll do an overview of like maybe an opposition player, an old great player, you know, like someone like Dan Fouts or someone like that. So that's it. I don't need to focus on that, but it's Raider Greats. So at youtube.com @Raider Greats. Let's go back to it. If you want to subscribe to it, the website is raidergreats.com. I'm not, obviously this website is all for financial, but if you're into if you're into football, I would appreciate it, et cetera, et cetera. So I hope you enjoyed this. It was longer than I expected, but I just wanted to show you again how thin and narrow the market is. And, again, the housing affordability. So it wasn't really 4 charts. It was a whole bunch of charts, but I hope you found it informative. I'm going to put this up to the website. Nice little thing to watch before the football games on Sunday. And I guess, sorry to Steeler fans out there, go Raiders tonight. And actually, again, I don't want to get rid of any Steeler fans that are potential subscribers to Stock Chart of the Day, or have been, but the Steelers, probably along with the Patriots, are the teams like I hate the most, you know, especially because of the old rivalry. I think a lot of Steeler fans, not the hardcore ones in Pittsburgh, but I think they're kind of bandwagon fans because the team has been good for so long. You know, and being a long-suffering Raider fan, I have something against that. So everybody take care, and I hope you found this informative.